Hi everyone, it's Leslie Batson. We're here for another episode of Rebel Rock Money Talk. In today's episode, we're going to talk a little bit beyond now savings and we're going to get into the next step, which is investments, right? So we've talked about all the benefits of whole life insurance and how you can use that to build up the capital that you would use and invest. And it's also where you would place the income from your investments so that it can grow safely. So we want to start talking about some of these alternative investments. So today's episode is on syndication. You're going to meet Julie and Annie. They co-founded Goodegg Investments, and they're going to get into in this episode telling you what syndication is, what does that mean, how they started Goodegg Investments, and what they do and what the investment opportunity is. Like just really what is syndication and how what you would consider in investing with them. But I wanted to also mention in this introduction, because literally just today as I'm putting together this episode, I saw that they have now launched their book. And this was not available when we had done the interview, so we didn't talk about it in this. However, I do encourage you to go to goodegginvestments.com/book. And you can sign up, go there. You can get a free copy of the book. You're just going to pay for shipping, but you get a free copy of their book. And I think that you'll see in this interview that they are two smart ladies. They know what they're doing, and they're really great at explaining and educating. Again, falling in line with how we like to do things at Rebel Rock. So I hope you enjoyed this interview, and here it is. Welcome, ladies. I'm so glad we were able to get together. I have Julie and Annie here from Goodegg Investments. And just a little background, I met Annie when I was at FinCon this year, 2019 in DC. And she had a great, great session. Of course, the room was packed, like literally standing room only. And it was great because they were talking all about real estate investments. It was her and a panel of other folks who focus on real estate investing. And as you know, we like to educate you and expose you to different opportunities where you can grow your money outside of the stock market. So I was so excited to connect with Annie, and Julie wasn't there, but I'm so glad to get a chance to speak with her now. And all of you will now get a chance to hear more about what Goodegg Investments has in store. So welcome, ladies. Julie and Annie, welcome.
Thank you so much, Leslie.
All right, so today we're going to talk about investing in apartment buildings and opportunities that Goodegg Investments offers. So I'm going to just pull us back to the beginning and just share, I guess, if I don't know who wants to take it, but if you can just share a little bit about Goodegg, how you guys got started, what you're about.
Well, I think Julie and I have very similar stories. We both sort of fell into real estate completely by accident. And we didn't start out investing in apartments. Absolutely not. We started out doing something called house hacking, which is where you either buy a multifamily, small multifamily, like a duplex, live in one unit and rent out the other. Or in Julie's case, she was renting out bedrooms in her home. So really kind of an industrious way to make use of your space and to get some rental income. And so we both became accidental landlords. And this was about 10 years ago, long before we had met each other. And then along the way, we sort of got into this real estate thing. We're like, this is pretty cool. You know, other people paying us, helping us pay down our mortgage. And so we both started to explore what it would look like to put more money into real estate. And we both started to invest out of state, again, not in huge apartment buildings, just in smaller properties, single family homes and small multifamily properties. And so we had been doing that over the past few years. And then separately, we both stumbled into this thing called real estate syndications, which is essentially like crowdfunding for real estate. And so it groups together a bunch of people who all have money to put into real estate. They want to own real estate, but they don't want to do any of the work.
Mm-hmm.
And so we both stumbled upon this concept. And as busy working moms, we were like, holy crap, this is amazing. You mean I get to have all the benefits of real estate and I don't have to deal with any of the headaches of being a landlord? And so with syndications, the great thing is because you're leveraging these partnerships, and sometimes there's hundreds of investors investing together, you don't, you're not buying a single family home. Now you're buying something much bigger, like an apartment building. And
Mhm.
with that, you get a whole lot of other benefits, which I'm sure we'll talk about, among them economies of scale and greater tax benefits. And so we both fell in love with that and had friends and family who wanted to invest with us. And so starting there, that's where Goodegg was born.
I love that. I love that. So where did the name Good Egg come from? What does that mean?
Goodegg is building your nest egg and investing for good, hence Goodegg
Ah,
Investments.
I like
Mhm.
that. I didn't know that.
And
Okay,
all
great.
of our investors are good eggs. So
Right. Of course, of course. So you ladies are in Southern California, is that right?
Northern California.
Northern California. Okay. So obviously the cost of housing is very expensive there and it just continues to go up. So it makes complete sense. Even if we're multimillionaires, I mean, obviously you want to make sure that you can cut down on the cost of housing. I mean, it's really, really out of control. So how did you start making decisions about investing outside of your market?
Yeah, I'll take that. It so basically, as I was moving out of the properties that we owned here in California, I started to think, okay, what's the next step for us, right? Because we had bought in 2009, we're selling in 2013 and 2016. And so we had come into some equity, right? And so it was like, what's the next thing that I can do with this money where it's the highest and best use, right?
Right.
And my mindset was still in the thought process that buying a primary home is the way that we build our wealth. That's what we're taught, right? And
Right.
so I thought, okay, I'm going to go out there and I'm going to plunk $500,000 down into a $2 million home, and I'm going to work my job for the next 30 years of my life, trying to pay down this, crazy mortgage
Right.
every month for 30 years. And something about that as we were moving through the loan process was just didn't sit right with me. And
Hmm.
so something kept telling me there's got to be a better way to grow my wealth and to have my money serve me today instead of 30 years from now, if I even lived for 30 years, right? Like everyone
Right. Right.
that you're going to be alive for the next 30 years, but the truth is you don't know, right? And so I started to look into different types of real estate investing, flipping, hard money lending, all types of things. And I realized that what I was really after was cash flow, which was like this novel idea because I live in California and everything we do here is for appreciation. And
Right.
so this thought of being able to invest in like a single family home or invest in real estate and have it pay me every month was like, oh my goodness, this is what I need to do more of. And so I started researching on Bigger Pockets. I don't know if you've heard of Bigger
Oh yeah.
Pockets or not,
Yeah.
but a great resource for new folks and even experienced folks trying to get into real estate. And just started researching markets. And I discovered a couple of markets that I thought would be good to start buying single family homes. And it's sort of the rite of passage. That's where people start, is with rental homes, because that's kind of the next step, right? After you buy your primary home, some people start to think about buying rental homes. And so that's what
Right.
I did. And I started buying single family homes out of state for cash flow. And it was great, but it didn't come without, a ton of headaches, right? I'm rehabbing these properties from 2,000 miles away. And I had a break-in, I had an eviction, all within like the first 8 months of owning these homes. And
Wow.
so it was just a lot, I 3 kids, working a full-time job. It was just not really feasible to scale and do
Right.
more of that. And so, but I knew I wanted all the benefits of investing in real estate. I wanted the tax benefits, I wanted the cash flow, and I wanted the equity. How was I going to get that? But I didn't have the time. And then that's when we discovered syndications. And that's when everything for me, game changer, just total game changer as a busy working mom. I discovered it, put in a lot of research, and made my first investment. And then, met Annie, and, we're here today. But it was really, starting out with the idea that I wanted to have my money work for me today. And that the only way I could do that was by investing out of state, because in California, it just wasn't going to happen. Right. So,
Right.
yeah. So that's kind of
Right.
how that came. Mm-hmm.
Yeah, and that's one of the principles that, we talk about a lot is cash flow. I mean, I know there's a lot of emphasis on your net worth, And not that that's not important, but net worth is really made up a lot of equity. And equity, you can't take a brick from your house and take it to the grocery store, right? So you really want cash
Oh,
flow. You want
I've tried.
Yeah, exactly.
Pain
I
in
haven't
full
dared
is
to try yet.
everything.
But yeah, so you need to have cash flow. It's having money available and available to use and work for you, not waiting, until you're 65, which is this, random number, random age. But yeah, being able to have money work for you now and on to whenever you want it to stop, really. So I love that.
Right. And to have it serve you today is really like this idea of what I was after. And it took me a while to really understand what, when you come into money or when you have money sitting in a bank account, what does that mean? And
Right.
what do you want it to do for you? Right. Because
Right.
sitting in the bank, it doesn't really mean much other than net worth, but it's not really like serving you. And so I realized that through the cash flow piece of it, that's what I wanted, was something to serve me today by allowing me to live a different lifestyle or a more comfortable lifestyle, or potentially free me up from my job, allow me to spend more time with my kids. Like it's opened so many doors. So yeah.
Yeah. And that's so important because just like you said, it's like the cash sitting in the bank account is actually costing you money because you're earning less than inflation. So it's actually literally costing you money for it to just sit there and not do anything, right? So, okay, so how did you and Annie meet up? How did you connect and put together Goodegg Investments?
Well, we met at a real estate conference about almost 2 years ago. And we struck up a conversation because we were both Asian women in real estate. First of all, being women in real estate investing is an anomaly. And then Asian women, we were like, holy cow, like, you're like me. And so we struck up a conversation just about being women in real estate investing and also being moms. And what that was like to balance the busy life of being a mom and also, like Julie was talking about, how to put your money to work for you and how to teach your kids about this whole world of investing. And so we just had a great conversation. And I had just quit my job right before that conference. Julie went home and quit her job right away. But we didn't talk about forming a partnership. In fact, we were both going to do our own separate businesses. And so over the next couple of months, that's what we did. We were just running our own separate businesses and met up a couple more times. And then one day we met up for a working session in the city. And so we were at a cafe and we're sitting across the table from each other. And Julie goes, so what is it about this business that you love the most? And I started, are you kidding? If I could just create content all day long, write blog posts and educate people, create videos and online courses, I would be in heaven. If I could take one thing off my calendar, it would be talking with investors. It just breaks up my day. They have all these questions. And she says, are you kidding? I love those conversations. I live for those questions. And she's like, for me, it's, I'm sitting there and I know I'm supposed to write a blog post, but I don't know what to write about. And so we're sitting there, we're like, so you like that and I like this. And we're both trying to help the same people. I'm in the same line of business. And so that's when we realized we had such complementary skill sets. And we were very aligned on our vision and mission for what we were trying to build. And so that's when we formed the business right about 1.5 years ago.
Wow, I love that. You guys struck the lottery there.
We really
found
did.
Someone who will do the other part that you really don't want to do, so you can leverage your own strengths. Yeah.
When I got into this, I saw other people with partnerships and I was like, oh, that'll never be me. It's impossible. It's like finding a needle in a haystack to find somebody who will match your skill sets, but also that you get along with. And so we really did strike the lottery there.
I love that. Okay, so why don't you share a little bit more about syndication? So what exactly is syndication? If someone wanted to, be part of your program, what would that actually mean?
Go ahead, Annie.
Sure. So a syndication is just a fancy word for a group investment. So I likened it earlier to crowdfunding. So if you think of like a Kickstarter campaign, right? It's like a bunch of people putting in a little bit of money to do something together. And so with a syndication, it's a similar concept. It's instead of you going out and buying your own rental property and then having to do all the management yourself, find the tenants, all that stuff yourself, you are putting in some money. And Julie's putting in some money, Leslie's putting in some money, all these people have some money to put in, and we group that together, we pool that money together, and now we can buy something bigger like an apartment building. And so as passive investors, those people who are just putting money in, we don't really have any active responsibilities. We're just getting that monthly cash flow, and we're sharing in the returns when the asset is sold. But there is a team that's actually leading that syndication or that group investment. And those are the people who are doing the heavy lifting. They are managing the asset, they are executing on the business plan, making sure everything runs properly. When the toilet is broken, they're the ones who have to deal with that, not us. And so that's really at the heart of it. That's what a syndication is. It's just a grouping of people and a pooling of resources.
Perfect. So how do you guys go about finding your projects or investments, or the teams that work on these investments?
Yeah, so it's really about being networking and attending events, kind of like FinCon, but for real estate type of real estate related conferences. And Bigger Pockets was where I met a lot my first partners like 3 years ago. That's where I met them and developed a relationship. And really, it's not so much that we go out there and we look for deals. It's really we're going out there and looking for partnerships first.
Mm-hmm.
And then we build these friendships, really is what it is. That's kind of where it starts, is through a friendship. And we start just talking about, hey, you're in commercial real estate. I want to get into commercial real estate. What is your track record? What have you done? If it sounds interesting and it sounds like somebody I want to work with, maybe I invest with them first, or we invest with them first. And if the experience is going well and we like the market and it seems like it might be a good fit for our investors, then we bring it over to our investors. And really, it's very important to vet the people that are managing the investment first before you start digging into deal specifics. So never look at a deal and then just say, okay, this deal looks good on paper, and sure, throw $50,000 at it, right? Like really get to know who the players are, right? So get a big idea of like who the major players are, what all their track record is. Identify someone who's kind of like in line with your feeling about how an apartment should be managed and operated,
Right.
and then start asking to look at their investment summaries. And then from there, so it's kind of like a big funnel, right? You have all these operators, and that's kind of the way we work too, is we just have a bunch of folks that we talk to, but only a small handful of those that we actually end up working with, and maybe 3 or 4. And then we look at the deals. So as they put out a deal, and they invite us to partner with them on the deal, is it something that we want to partner with them on? And so what ends up happening is our investors end up getting really the best of the best because of the way we're vetting the operators and then the deals, and then only accepting some of those deals out of the best operators that we've decided to work with. But really, that's kind of the process of how it starts. And then when we look at a deal, it's so many things. I mean, we can get into that if you want to, but when we look at whether we're going to do a deal, it really starts with the operator first, because at the end of the day, anybody can put anything in an investment summary, right? And it can look great on paper. But if you don't know when things go wrong, if you don't have the right team on the deal, they're not going to be able to make things go right. And so that's the big thing that we look at is, who are these people? What is their track record? Even if the deal doesn't necessarily look like a home run deal, even though we may know it is, but some of our investors may question, the LTV, which is the loan to value. They may question the type of financing we're getting on the property, and all these little nuances. And while all of that is certainly important, excuse me, I think it's way more important to really understand who you're working with and what their track record is, and specifically how they've the decisions that they've decided to make when in the face of things like not going right? Like
Right.
that's the big question, is like when things start to go
Exactly.
wrong, how did they handle that? Because when things are good, everybody's happy and, there's no problem. But the big
Right.
question is when things go wrong, what
Right.
decisions did they make? So always ask that question as well. What are your mistakes? How did you learn from them? What are you doing moving forward to proactively prevent that from happening again? Those kinds of things. So, yeah.
Right.
And so that right there is a big piece of the value that we provide our investors, is that, as you can imagine, it takes a lot of time to go
Mhm.
out there and talk to these operators, to ask them questions, to really dig into who they are as people, and to vet all these investments. So that's what we do on behalf of our investors, because we're part of this world. So we go out there, we go to the conferences, we create the relationships, and so our investors can be sure that by the time an investment summary actually hits their inbox, that we have vetted those partners and those deals, and those are deals that we would invest in ourselves.
Yeah, due diligence is so, so critical. And not, like you
Mhm.
said, not just of the deal, but of the people. So
Yeah.
that's so critical. So can you give an example of like this, like a type of a property, like a type of investment, like size-wise, number of doors, or that type of thing?
Yeah, so traditionally we're buying, and we have ones on different ends of the spectrum, but right in our sweet spot, I would say is somewhere between 2 to 300 doors, B class. So I don't, if your audience doesn't know what classes of assets are, it's A class new build luxury, B class workforce housing, affordable housing, C class, more kind of like affordable housing, and then D class, definitely where you probably don't want to be. So we focus on the B class. And the reason that we focus on that is because we believe that we know we're not at the bottom of, we're not at 2008, 2009. Are we at the top? Who knows? But if the recession were to come tomorrow, what's going to happen? People will lose their jobs. They can't afford to pay. So instead of, investing in these apartment communities where it's like the luxury, expensive new builds, we're investing just one step down, but in those A class areas, right? So when the recession comes, people who are currently living in the A class luxury apartments or in the A class neighborhoods, but want to stay there but can't afford it, are going to move down to the B class affordable housing. And so that's why we focus on that.
Mhm.
And then we also focus on what we call value add. And so what that essentially means is you can kind of think about it like buying a property that needs a little bit of interior renovation. So we're not buying anything that needs a lot of what we call CapEx repairs, or large capital expenditure repairs, which are things like roof and foundation, plumbing issues. Usually that's like really old C-class properties. And the reason we don't do C-class properties with regard to the large CapEx repairs is because we feel like if a recession comes, then it could end up being very costly to make all of these repairs at a time when maybe occupancy might be dropping, and it can be like a kind of a quick downward spiral. So between the B class, the value add, and the unit sizes that we're investing in is really for us a hedge against any kind of downturn that we know we're headed for. So,
Yeah, no, that makes total sense. Total sense.
yeah.
So what, I guess, how many projects or properties have you guys done? You said you've been in together for a year and a half. So how many projects has Goodegg Investments put together?
Yeah, so over the last 2 years, so I started out first and did a couple of deals on my own, 3 deals. And so those combined with the ones we've done, we're at, I think, 23 deals,
Mm-hmm.
Oh, wow. That's great. That's
Yeah.
good experience. And are they, so you mentioned they're all over the country, or do you limit to certain states, or what are your, I guess, strategies around location?
So most of our investments are in Texas and the Southeast.
Okay.
And what we're looking for when we're looking at the markets is, number one, is we're looking for a market with strong job growth.
Mhm.
Because with job growth comes people moving to the area for those jobs. And what do those people all need?
Somewhere to live.
And so that will, yeah, exactly. It turns out people like to live indoors.
Imagine that.
I know. And so that's what we're looking for first and foremost, is that that job growth, and along with that also job diversity. So we don't want all the jobs to be in a single sector. We want it to be pretty balanced across different industries. So we're looking for a number of different things, but those would be the top ones. And now it's a lot of the Texas markets like Dallas, and then across the Southeast and Florida markets as well.
Okay, great. Okay, so how would someone, do you have eligibility, or how does someone qualify to invest with you?
They have to take a very stringent 12-hour test. We just kidding. Just kidding. For many of our investments, investors do have to be accredited. And what that means is you don't have to take a test. It's for the most part, it's a self-report, but it's based on meeting one of two criteria, either a net worth criteria or an income benchmark. So either you have to have $1 million or more in net worth, not counting your primary home, or you have to make $200,000 or more as an individual, or $300,000 or more together with your spouse, and have done so for the last 2 years and intend to continue doing so this year. So if you meet either of those criteria, then you are considered accredited. And so in the eyes of the SEC, that means you figured out how to make some money, and thus you're eligible to invest in more of these investments. And so all of our investments are open to accredited investors who are also sophisticated, meaning they understand the risks going in.
Right.
Now, if you don't meet that benchmark and you're non-accredited, you can still invest in these opportunities, but you will have to have a personal relationship with the people who are doing the deal. And that's just to protect you, to make sure that somebody's not just pulling you willy-nilly into a deal and getting you to invest a lot of money into these deals.
Right.
So that would be the criteria, is either accredited for all of our deals, or sophisticated, non-accredited for some of our deals.
Okay, great. And then what is your minimum investment?
50,000. Mm-hmm.
Okay. All right. And then you will take more. So if you have a project that, obviously maybe you're looking to raise $1 million and someone has 200, or would you allow them to put in that much, or do you limit how much each person can contribute?
There is a limit, but it's usually pretty high on most of the deals we do. But yes, 50 to 200,000, I would say, is the average that most people invest on any given deal.
Okay. All right.
And that's one of the biggest benefits, I would say, of investing in a syndication versus investing in a rental property. If you're looking for a rental property, you have to find a specific property and then put a specific amount down, right? But with a syndication, we take 50,000 and then we take increments above that. So if you wanted to invest 75,000 or 80,000, you can really choose exactly how much you want to put into the deal.
Mm-hmm. Yeah, I like that flexibility.
Mm-hmm.
Okay, so once someone is eligible, they're ready to invest, what do they do? What's that next step?
Yeah, they can just go to our website and sign up. Goodegginvestments.com/invest, I think, is the address. And once they sign up there, they'll be routed to schedule a call with me. And then we'll hop on the phone and we'll really dig into what their real estate investing background is, if any, and what their real estate investing goals are. And it'll be a chance for us to kind of get to know each other and to see if our investments are a good fit for them. Because if somebody comes to me and they say, well, I'm looking for 15% cash returns, right? Because ours are somewhere in the 8 to 10%. I would have to tell them that that's not, we do roughly about a 16 to 18% annual return, but that's after sales. So if you're really looking for, high cash flow play, not going to be any of the deals. So we really dig into all of those questions, because the last thing we'd want to do is get you into an investment that's not, a good fit for for our investors. So,
Right.
yeah. And then after that, then they're in our investor club. And then once they're in our investor club, then they're privy to see, all of the deal flow that we have available as it becomes available. Yeah, that's kind of the process. And then once you identify an investment opportunity, it's just a matter of getting your questions answered and then signing the legal documents and funding and, doing your due diligence. I would say these types of investments are very passive once you move past the due diligence phase, meaning vetting us, vetting the operator, vetting the markets, looking at the deal. But once you close on the deal and you've signed the paperwork and you've funded, it's after that, it's just maintaining and making sure that you've received your distributions timely and, that kind of thing. But other than that, it is very passive. So.
Okay.
Well, that brings up something that a lot of investors ask us. So I'm sure there's listeners who are listening to this who are thinking, wait, I want to know what the projected returns are.
That was my next question.
Always ask us about that because they want to be able to, I get it. They want to be able to compare it and say, well, if I put my money in the stock market versus a syndication versus a rental property, where is my money going to work the hardest for me?
Yeah.
And so I'll tell you about our typical returns. And again, these are projected, they're not guaranteed. But typically when you're investing, and again, the minimum is 50,000, but the numbers are easier on 100,000. So let's say you invest 100,000. It's typically over a 5-year hold period, which means that we're going to buy it today and then we're going to hold that asset for 5 years. And during that time, you won't be able to pull your money out. So it's an illiquid investment. So you shouldn't invest with money that you need next year or next month for that kitchen renovation or for your kids' college fund. You want to invest with money you won't need for a while. And so it's a 5-year hold. And what we're doing during that 5 years is really the first couple of years, we're going in and renovating all of the units. And so Julie mentioned those cosmetic updates, and that's what we're doing is we're not kicking anybody out, but when we buy a 200 unit apartment building, there's already some units that are vacant right off the bat.
Right.
So we start by turning those over. And then as people's leases come due, then we offer to move them into these brand spanking new units. And usually they're thrilled.
Yeah.
And so they move into those units, pay a little bit of a premium, and then we start to renovate their vacated units and on until we get through everything.
Okay.
And so as we're doing this, you're not sitting there, just idle. You're getting monthly reports about what we're doing, what we're up to, the units that we're renovating, and you're getting monthly cash flow. And so that comes out to be about 8% per year, which on 100,000 comes out to $8,000 per year or about $667 per month.
Okay.
And then on the back end, and in year 5, when we sell the property, then you can expect to get another, say, about 60% or about $60,000. So you get your original $100,000 back. You've gotten about $40,000 in cash flow over the 5 years, and you get another $60,000 in profit. So all in all, we look to double your money from $100,000 today to $200,000 in 5 years.
Wow. So 100% return in 5 years.
It's what we aim to do. Yep.
Yeah. No, that's a great deal. Now, what I really like about what you guys do is the fact that it's really the blend of growth and income type of investment. So like you said, you have to know that that money is not going to be accessible to you once you've, invested that principal, but you will still be getting some cash flow along the way. And then you get it back, at the end. So I think it's a great opportunity. I always love real estate investing just because, to me, the IRS laws are set up for housing. The benefits are all around real estate investing. They're set up around businesses because they think you're going to create jobs. So, you really want to, put your money in places where it makes sense. So this sounds incredible. And of course, working with you all, then you're truly passive, like you said, once you've kind of gone through, done your due diligence and you've decided to move forward, you signed on the dotted line, then you're really just waiting for those checks.
Yep. Yeah.
So that's a great opportunity for investors. Okay, great. Is there anything else that you would like to share? I know that if someone isn't quite ready to invest, but they want to learn a little bit more. You guys have something for that as well, right?
Oh, we have tons of resources for that. But one of the best resources I would say is if you go to our website, goodegginvestments.com, right there on the front page, you'll see a sign up for what we call Passive Real Estate Investing 101, which is a free 7-day email course. So we'll send you one email a day for 7 days. So nothing overwhelming, just talking about a lot of the things that we've talked about in this call and giving you more resources so you can start to dig deeper.
Okay.
So that would be a great place to start. And then from there, we'll start to introduce you to additional resources as well.
Okay, great. I love that. Because it's great to have content because not everyone is ready to take action right away. They're just kind of figuring out what do they want to do when they are in that position. So yeah, good to have all that information. All right. Is there anything else you would like to share? No? Okay. Well, you've shared a lot. I mean, it's really good information. Like I said, I totally love the fact that you're doing this. I love that you're a company, two women of color who are just totally, because I'm part of a real estate investment group, and there's definitely way more men, older white men, than you see women and women of color. So, we definitely want to make sure that we see more of us there because we want to be able to reach more and more of our communities. So kudos to you guys for finding each other and being able to work together because you each meet the other's sort of gap. So that's great. It's great synergy.
Yeah.
And if anybody wanted to reach out to either of us directly, because we're always open to answer any questions or to chat further. So you can reach out to me, Annie, at goodegginvestments.com or Julie at goodegginvestments.com.
Okay, great. Well, thank you, ladies. I really appreciate your time.
Thanks so much for having us.
Absolutely.
Okay, we will talk soon. Thank
Okay.
you. Okay, bye.